Well, ladies and gentlemen, look at the calendar. It is Monday morning, December 29th, 2025, and I need you to take a deep breath and look at your screen. I know exactly what you're feeling right now. That cold knot in your stomach, that creeping panic as you watch silver, the metal that was supposed to be your financial lifeboat, flash red, plunging to $75 in a matter of hours. Just days ago, we were eyeing triple digits. Today, the headlines are screaming that the bubble has popped. The experts are telling you to cut your losses before it hits $50. Stop. Listen to me very carefully. What you are witnessing is not a crash. It is not a correction. It is a ghost week trap. Right now, the sharks of Wall Street are in Aspen or the Hamptons. The senior risk managers are gone. The trading desks in Manhattan are empty. Who is running the market this morning? It's the B team. It's the algorithms. It's the ghost bots hunting for your stop losses in the thinnest liquidity of the year. In a normal market, selling 1,000 contracts is like throwing a rock into the ocean. But during Ghost Week, there are no buyers. The order book is hollow. That same rock is now being thrown into a bathtub, and the splash is designed to drown you. They are manufacturing a $75 price tag to trigger your panic. But while you're being hunted in New York, the real world is telling a different story. While you are being told your silver is worth $75, they are paying $89 for that exact same ounce in Shanghai. That is a $14 Shanghai Divorce. It is a financial vacuum that is currently screaming at the top of its lungs. You have to ask yourself, why would the smart money smash the price 3 days before the world changes? We are 72 hours away from the January 1st export ban, the moment the supply line to the west officially snaps. Do you really think they're selling because they're scared? No. They are shaking the tree to see what falls out. They want your seat on the train before it hits $100. If you sell now, you aren't saving your capital. You are handing your winning lottery ticket to the very people who engineered this panic. I am going to show you the mathematical proof of the Ghost Week trap, the reality of the Shanghai premium, and why the slingshot back to $90 is not just a guess. It is already programmed into the system. The numbers on your screen are a psychological operation, a digital illusion designed to trigger the ancient lizard brain response of flight. When you woke up this morning and saw that vertical red line slicing through the support levels like a hot wire through wax, your heart rate spiked for a reason. That $75 print is meant to feel like a death sentence for your thesis. It is meant to make you feel isolated, foolish, and poor. But what you are looking at isn't the true value of silver. It is the red morning illusion. It is a price discovered in a vacuum, a ghost light flickering in the dark to lure you off the path. This isn't a market behaving normally. This is a market that has been hollowed out from the inside, leaving only the ghosts of algorithms to haunt the tape. To understand why your screen is lying to you, you have to understand the mechanics of the Ghost Week vacuum. We are currently in that eerie, low-volume purgatory between Christmas and the New Year. In the world of high finance, this is the dead zone, the titans of the industry, the guys who actually move the heavy physical weight, the senior risk managers who have seen every cycle since the 1970s, the billionaire whales who provide the bid under the market. They aren't in the office. They are in Aspen, they are in St. Bart's, they are on yachts where the satellite internet is too slow for day-to-day trading. They have closed their books for 2025. They are done. So who is left at the controls? The junior desks, the B team, the interns and the 20-something associates who were unlucky enough to draw the holiday shift. These are people with zero institutional memory and even less courage. They are babysitting the tickers. And more importantly, they are sharing the room with the sharks, the high-frequency trading algorithms that are programmed to do one thing and one thing only: exploit the lack of liquidity. In a normal trading week in October or April, the silver market is like a deep, wide river. If a massive hedge fund wants to dump 5,000 contracts, it's like throwing a boulder into that river. There's a splash, sure, but the current is so strong and the volume is so deep that the water levels barely change. There are thousands of buyers, bullion banks, industrial users, and retail speculators waiting to absorb that selling pressure. But during Ghost Week, that river has dried up into a shallow, stagnant pond. When an institutional player decides to smash the price today, they aren't throwing a boulder into a river, they are dropping it into a bathtub. The water doesn't just ripple, it gets displaced entirely. The splash covers the floor, and for a few terrifying minutes, the tub looks empty. This is the vacuum. When the order books are this thin, it takes almost no capital to move the price. In a high liquidity environment, moving silver down $5 might cost a bank billions of dollars in selling pressure to overcome the buyers. But this morning, with the buyers away at holiday parties, it likely took only a fraction of that. They wait for the moment when the bids, the standing orders to buy, are at their lowest. Then the algorithm strikes. It fires a rapid-fire burst of sell orders into the void. Because there is nobody there to catch the metal, the price gaps down. It doesn't trade down, it teleports. It skips from 78 to 77 to 75 in the blink of an eye because there were no orders in between to stop the fall. The algorithms aren't just selling to sell, they are hunting. They are programmed to know exactly where you, the retail investor, have placed your pain threshold. They have a heat map of every stop-loss order sitting on the COMEX. They know that thousands of traders who bought the breakout at 78 holders placed their safety net stop-losses at 76. By forcing the price down into the vacuum, the bots deliberately clip those stops. The moment the price hits $75.99, your broker's computer automatically triggers a sell order. You aren't even awake yet, but your position is being liquidated. This creates a self-fulfilling prophecy, a liquidity cascade. Your forced sell order hits the market, which pushes the price down another nickel, which triggers the next guy's stop loss, and the next, and the next. It is a digital stampede where the only ones making money are the ones who started the fire. They sit at the bottom of the gap at $75, waiting with their buy buckets open. They are effectively shaking the tree to see how many scared hands will drop their physical claims. They want to buy back the very contracts they use to smash the price, but at a $5 discount, funded entirely by your panic. The psychology of this red morning is masterful because it plays on your sense of timing. You know that January 1st is the great severing, the day China shuts the gates on silver exports. The banks know you know this. They realize that if they don't get you out of your position now, they will never get you out. Once the calendar flips to 2026 and the physical reality of the shortage hits the news cycle, the paper price will lose all power to scare you. This 72-hour window is their last chance to use the Ghost Week vacuum to create a fake reality. Think about the sheer absurdity of the narrative they want you to believe. They want you to believe that on a random Monday morning in late December, the world suddenly decided silver was worth 7% less than it was on Friday. Did a massive silver mine suddenly open in Central Park over the weekend? Did Elon Musk announce he found a way to build Teslas out of plywood instead of silver-coated electronics? No, the fundamentals are screaming higher, but the ticker is screaming lower. When you see that $75 price, you have to realize you are looking at a mirage print. It is a price that exists only in the digital ether of a hollowed-out market. If you were to pick up the phone right now and try to buy 10,000 ounces of physical silver at $75, you would be laughed off the line. The physical dealers haven't moved their prices. The Shanghai Gold Exchange isn't seeing a crash. This is a local storm in a very small, very manipulated Western teacup. The junior traders running the show today don't care about the 2026 supply-demand deficit. They are looking at a screen, playing a high-stakes game of capture the flag with your capital. They are exploiting the fact that the adults are out of the room. They are using the vacuum to create a visual of failure. But a vacuum, by its very nature, must be filled. In physics, a vacuum creates suction. In finance, a price gap in a bull market creates a financial vacuum that eventually pulls the price back up with twice the force it went down. This $75 mark is the ultimate bear trap. It is a fake-out designed to clear the decks of everyone who is trading on emotion rather than math. The sharks are currently feasting on the holiday leftovers of the retail market. They are betting that you will look at the red numbers, feel that knot in your stomach, and surrender. They are betting that you will value the price more than the metal. But as we move closer to the new year, the vacuum is going to flip. The same lack of liquidity that allowed them to smash the price down to $75 is going to be the same reason the price slingshots to $90 the moment the buyers return. You are being given a gift, a chance to buy at the ghost price before the world wakes up to the real price. And the only question is, are you going to let the B team steal your future, or are you going to see through the red morning illusion? The predator doesn't hunt in the open meadow where the light is clear. It hunts in the tall grass where the vision of the prey is obscured. In the world of precious metals, that tall grass is the $76 price level. To the average retail investor, $76 was a line in the sand, a calculated safety net intended to preserve capital. But to the institutional algorithms currently prowling the COMEX during this hollow holiday week, that $76 mark wasn't a floor. It was a bullseye. We are witnessing a clinical, cold-blooded technical breakdown known as a liquidity grab. To understand why your position was just liquidated while you were pouring your morning coffee, you have to understand the predatory architecture of a stop-loss hunt and why the sharks needed to clear the deck before the massive New Year breakout. Every retail trader is taught the same basic risk management strategy by the same textbooks and YouTube gurus. Protect your downside. If the market turns against you, get out. On the way up to $80, thousands of investors moved their stop-loss orders up to just below the recent support levels. They looked at the charts and saw a solid floor at $77. Naturally, they placed their sell everything triggers at $76 or $75.50, thinking they were being prudent. They thought they were building a fortress. In reality, they were building a concentrated pool of liquidity that the big banks could see clear as day on their proprietary order flow heat maps. These institutions aren't guessing where your pain threshold is. They can see the clusters of sell orders sitting on the exchange servers like neon signs. During a normal trading month, hitting those stops is expensive. The banks would have to sell massive amounts of physical backed contracts to overwhelm the natural buying pressure of the market. But during this ghost week, the cost of manipulation has dropped by 90%, because the order book is hollow, meaning there are very few people standing there waiting to buy the dip. It only takes a relatively small, concentrated burst of selling to knock the price over the edge. Think of the market as a massive ship. In deep water, it takes a hurricane to tip it. But today, the ship is in a dry dock, propped up by nothing but a few wooden beams. The banks only had to kick out one beam, the 78 support, to make the whole structure come crashing down toward that 76 cluster. The moment the price touched $75.99, the trap was sprung. This is where the cascade effect takes over. A stop-loss order is, by definition, a market order. When the price hits your trigger, your computer tells the exchange, I don't care about the price, just get me out now. When thousands of these orders trigger simultaneously, they create a massive wave of forced selling. This isn't conviction selling, it's robotic selling. The algorithms watch as the retail market essentially eats itself. The price doesn't just dip, it gaps down as the sell orders search frantically for a buyer that isn't there. This is what we call clearing the deck. The institutions want to ensure that when the real rally to $100 begins on January 2nd, there are no weak hands left on the boat. They want to flush out the leveraged players, the panicked amateurs, and the tourists who are trading on margin. They want the boat to be as light as possible so that when the engines roar to life, the ascent is vertical and uncontested. Who is on the other side of your panic? Who is the invisible buyer, sitting at $75.10, quietly scooping up every single ounce that you just surrendered at a loss? It's the very same entities that pushed the price down in the first place. This is the ultimate rinse and repeat cycle of Wall Street. They use their capital to trigger your fear, and then they use your fear to subsidize their own accumulation. By grabbing the liquidity at $76, they have effectively bought a massive amount of silver at a 5% to 7% discount without having to wait for a natural market correction. They manufactured the correction. They know that the physical reality of the silver market, the industrial demand for solar, the electronics shortage, and the impending Chinese export ban hasn't changed one bit. They are simply moving the metal from weak hands to strong hands. At a price that would have been impossible to get just 48 hours ago, this liquidity grab serves a dual purpose. First, it generates immediate profit for the desk. If a bank can trigger a sell-off at $76 and buy it back at $75, they've made a risk-free dollar per ounce in a matter of seconds. But the second, more sinister purpose is psychological warfare. By smashing the $76 level, they have broken the chart. Every technical analyst in the world is now looking at their screen seeing a lower low. The moving averages are crossing, the RSI is oversold, and the death cross narratives are starting to circulate on social media. This creates a secondary wave of selling from the people who weren't even using stop losses, but are now scared out by the visual of the crash. The banks are effectively using your own tools, technical analysis, and risk management against you. They are turning your safety into your vulnerability. You have to realize that in a rigged game, the house knows your cards. If you play the game the way the textbooks tell you to, you're playing right into the hands of the high-frequency traders. They thrive on predictability. They thrive on the fact that most retail investors act in a herd. By clearing the deck today, December 29th, they are setting the stage for the slingshot. Think about what happens next. The sell orders have all been processed. The stop-loss pool has been drained dry. There is no one left to sell. The market is now oversold and underowned. When the new year begins and the massive fundamental news of the China export ban hits the wires, there will be no resistance on the way back up. The deck is clear. The shorts have covered their positions at your expense, and they are now long and strong, waiting for the launch. The $76 stop-loss hunt is a rite of passage in every major bull market. It is the moment where the owners are separated from the renters. The renters saw $75 and felt like they were losing money. The owners saw $75 and realized the institutions were just giving them a second chance to load up. The banks are playing a game of chicken with your financial future, betting that you will blink before they do. They want you to believe that the magic of silver is over, right at the moment the physical supply is about to be severed from the global market. They aren't selling their silver, they are buying yours. They're clearing the deck of the passengers who don't have the stomach for the journey to 100. This morning wasn't a funeral for the silver squeeze. It was the final cleaning of the engine before the race begins. While the Western world stares in paralyzed horror at the flickering red digits of the COMEX, a silent revolution is taking place 10,000 miles away. To understand why that $75 price on your screen is a total fabrication, you have to look past the borders of the New York and London markets. You have to look at the Shanghai Divorce. For decades, the global silver market operated like a synchronized dance. New York would lead, and the rest of the world, including China, would follow the rhythm of the paper ticker. But as of this Monday morning, December 29th, the music has stopped, and the dancers have moved into separate rooms. The divorce is final, and the settlement is going to cost the Western banking system everything. As you sit there watching the flash crash in the West, the Shanghai Gold Exchange, SGE, is telling a story that borders on the surreal. While the algorithms in Manhattan are fighting over scraps at $75, the physical buyers in Shanghai are aggressively bidding the price up to the equivalent of $89 per ounce. This isn't just a minor discrepancy. This isn't a rounding error caused by currency fluctuations or shipping insurance. This is a staggering $14 per ounce premium, a massive gaping hole in the hull of the global financial ship. It is the single largest price detachment in the history of precious metals, and it serves as the ultimate statistical proof that the Western spot price has officially detached from physical reality. To grasp the gravity of this, you have to understand what the SGE actually is compared to the COMEX. The COMEX, where that $75 price is generated, is essentially a casino. It is a paper market where participants trade digital promises of silver. This $14 premium is a financial vacuum of unprecedented proportions. In a rational, functioning global market, such a gap shouldn't be able to exist for more than a few minutes. If silver is $75 in New York and $89 in China, every trader on Earth should be buying in the West and selling in the East until the prices equalize. This is called arbitrage, but the arbitrage is broken. The bridge between the two markets is burning. The reason the gap is widening to 14ths is that there is no silver left in the Western vaults to send to the East. The sharks in New York can push the paper price down to $75 all they want, but they can't force the physical metal to move at that price. The Chinese know the supply is drying up. They know the January 1st export ban is only 72 hours away. They are panic buying the physical reality, while the Americans are panic selling the paper illusion. The statistics are undeniable. If you track the volume of the SGE over the last 48 hours, you see a vertical spike in takes, actual withdrawals from the vaults. The Chinese investor isn't looking at the COMEX chart for permission to buy. They are looking at the empty warehouse shelves. They see the solar industry's insatiable hunger for silver. They see the massive industrial shift toward high-tech manufacturing that requires high-purity silver. They realize that $89 is actually a bargain. When you consider that in 3 days, the supply chain officially snaps. The Shanghai Divorce is the market's way of saying that the West has lost its mandate to set the price of the world's most important industrial metal. The pricing power has migrated east, and it isn't coming back. The implications of this $14 gap are catastrophic for the Western short sellers. Imagine you are a big bank in New York with a massive short position. You've spent the morning successfully smashing the price down to $75 to trigger retail stops. You're patting yourself on the back, feeling like the king of the world. But then you look at the SGE ticker. You see that despite your best efforts to devalue silver, the world's largest consumer of the metal is ignoring you. They are bidding $89. You've created a paper reality at $75, but you're surrounded by a physical reality at $89. Eventually, those two worlds must collide. You can't print physical silver to close that gap. You can't algorithm your way out of a $14 arbitrage wall. This is why the current volatility is so deceptive. The $75 price is a localized phenomenon, a New York problem. It is the result of a desperate, low-liquidity attempt to maintain control over a narrative that is slipping away. The East is no longer following the West's lead because the East no longer trusts the West's paper accounting. They see the 750 million ounces of paper silver traded for every 1 ounce of physical silver that actually exists in London and New York. They've decided to stop playing the game. By paying $89, the Chinese market is effectively de-pegging from the COMEX. They are setting their own price based on the actual physical scarcity they see on their own doorstep. For the retail investor in the West, this divorce is the ultimate insurance policy. If you were only looking at the New York chart, you might believe the experts who say the silver squeeze is over. But when you look at the Shanghai premium, you realize the squeeze hasn't even started. It's just being suppressed in one specific time zone. That $14 gap is a slingshot in the making. Markets abhor a vacuum. Eventually, the Western price will be forced to catch up to the Eastern price, or the Western vaults will be bled dry by anyone who can find a way to ship metal to Shanghai. The $75 price is a temporary air pocket created by the lack of holiday volume, but the $89 price is the destination. The Shanghai Divorce marks the end of the era of Western price manipulation. For decades, the bullion banks could use a few million ounces of paper, to dictate the value of the entire global supply. But you can't manipulate a market that refuses to acknowledge your price. China is the world's largest refiner, the world's largest consumer, and soon, with the export ban, the world's largest vault. When they say the price is $89, that is the price. The COMEX is just a noisy neighbor shouting at a brick wall. This Monday morning crash is the last gasp of a dying system trying to convince you that its paper is still worth more than the metal. Don't fall for the illusion. Look at the data. Look at the divorce. The East has moved on, and if you sell your silver for $75 today, you're giving away the most undervalued asset in human history to the very people who are terrified of the $89 reality. In a rational world, the 14 gap between New York and Shanghai would be a gold mine for any trader with a functional brain and a bank account. In the textbooks of the 1990s, this is what we call a risk-free trade. You buy silver at the manipulated paper price of $75 on the COMEX, you load it onto a plane, and you sell it for $89 on the Shanghai Gold Exchange. You pocket the $14 difference, rinse and repeat until the prices equalize. It sounds simple. It sounds like the ultimate get-rich-quick scheme. But as you watch the red numbers flash on this Monday morning, you need to understand why the smart money isn't closing that gap. Well, you need to understand the death of arbitrage. The bridge between the East and the West hasn't just been closed, it has been demolished. The plumbing of the global silver market is broken, and for the first time in history, the paper price is trapped in a burning building with no exit. The first reason this 14 foreign free money, which trade is a fantasy, is the reality of physical logistics. When you buy a silver contract on the COMEX at $75, you aren't buying a bar of silver. You're buying a piece of paper that gives you the right to request a bar of silver eventually. In a normal market, eventually might mean a few days, but right now, the Western vaults are experiencing a slow motion run. If you demand physical delivery of your silver today, December 29th, you aren't going to get it by tomorrow. You're entering a logistical nightmare of force majeure clauses, delayed settlement notices, and security audits. The big banks have turned their vaults into fortresses. They will give you every excuse in the book: shipping strikes, insurance blackouts during the holiday week, or lack of armored transport, to keep that metal from leaving their doors. By the time you actually get your hands on a physical 1,000-ounce bar, the calendar will have flipped to January, and the world will be a very different place. Even if you manage to bypass the vault delays, you would run headfirst into the shipping wall. Transporting millions of dollars in silver isn't like mailing a letter. It requires specialized armored logistics, specific international insurance underwritten by companies like Lloyd's of London, and clear passage through global shipping lanes. Right now, those lanes are clogged and the insurance premiums have gone vertical. During Ghost Week, the capacity for high-value armored transport drops to near zero. The junior desks aren't authorizing new shipments. The pilots are on break. The insurers have closed their books for the year to protect their 2025 bonuses. You could have a warehouse full of silver in New Jersey, but if you can't get an insured plane to fly it to Shanghai, that silver might as well be lead. The $14 premium exists precisely because the metal is immobile. It is stuck in a Western system that refuses to let it go, but the physical logistics are only the first layer of the trap. The real death of arbitrage is being driven by the invisible hand of capital controls. China is not a playground for Western hedge funds. To sell on the Shanghai Gold Exchange, you have to play by Beijing's rules. In anticipation of the January 1st export ban, the Chinese government has tightened the plumbing of their financial system. They have implemented strict know-your-metal protocols. They aren't interested in helping Western banks arbitrage the price down. They want the silver to stay inside their borders. If you bring silver into China today, you might get paid that $89 premium, but good luck getting that capital back out in US dollars. Beijing has effectively turned the SGE into a Hotel California for silver. You can check in anytime you like, but your wealth can never leave. The $14 premium isn't a glitch. It's a premium of sovereignty. It is the price China is willing to pay to ensure they own the physical reality, while the West drowns in its own paper lies. Furthermore, the broken plumbing extends to the very nature of the silver itself. The silver being traded in Shanghai is high purity, good delivery physical bullion intended for the solar and semiconductor industries. The silver being sold on the COMEX at $75 is often just a digital entry in a ledger, fractional reserve silver that might be released out to 3 different entities at once. When you try to bridge the gap between these two markets, you realize that you are comparing apples to digital ghosts. The Shanghai Divorce is a realization that the East no longer recognizes Western paper as a valid substitute for the metal. They are demanding the physical premium because they know the Western system is naked. The arbitrageurs, the guys who usually keep these prices in line, are terrified. They know that if they try to buy at $75 to sell at $89, they might find themselves holding a piece of paper in a market where nobody accepts paper anymore. This is why the $75 price is allowed to persist. It is a zombie price in a zombie market. The institutions pushing the price down in New York know that the arbitrageurs can't stop them. They know the shipping lanes are closed. They know the Chinese capital controls are in place. They know the Western vaults are effectively empty for retail delivery. They are operating in a laboratory-sealed environment where they can manipulate the numbers without fear of being called on their bluff by physical delivery. They are creating a liquidity illusion because they know the physical reality is currently out of reach for the average person. They're counting on you not knowing about the broken plumbing. They want you to look at the $75 price and think, if it were really worth $89, someone would have fixed the price by now. They want you to use the lack of arbitrage as proof that the $89 price isn't real. But the truth is the exact opposite. The fact that the arbitrage is broken is the ultimate warning flare. In a healthy market, a $1 price difference is an emergency. A $14 price difference is a systemic collapse. It means the global market has fractured. It means the silver bridge has fallen into the ocean. When the plumbing breaks, the water doesn't just stop flowing, it starts to back up. Right now, the silver demand is backing up in the east, and the paper debt is backing up in the west. On January 1st, when the export ban goes live, the last few drops of leakage from east to west will be cut off completely. The $14 gap will no longer be an arbitrage opportunity. It will be the new baseline. The death of arbitrage is the final stage of the transition from a paper standard to a physical standard. The banks are using this ghost week to maintain the illusion of control, but they are doing it in a room with no exits. They can't ship the metal to China to bring the price down there, and they can't stop the Chinese from bidding the price up. They are trapped in a $75 box of their own making. This 75 crash is a desperate attempt to convince you to sell your physical metal into their broken system, so they can use it to plug the holes in their own balance sheets. They need your silver because they can't get it from the miners, they can't get it from the vaults, and they certainly can't get it from Shanghai. Do not let the broken plumbing of the global market trick you into thinking your asset is worth less than it is. The $75 price is the exit price for the panicked. The $89 price is the entry price for the powerful. The bridge is down, the ship is sinking, and the only thing that matters now is which side of the ocean you're standing on when the January 1st deadline hits. The arbitrage is dead, but the value is very much alive. The slingshot is being pulled back to the breaking point, and when it releases, the $75 paper illusion will be obliterated by the $89 physical reality. The date on your calendar is December 29th, and we are now standing on the precipice of a structural tectonic shift that the Western mainstream media is refusing to acknowledge. While the talking heads on CNBC are obsessing over the $70 paper price and the unfortunate holiday volatility, they're ignoring the massive smoking gun that officially goes off in exactly 72 hours. On January 1st, 2286, China, the world's dominant force in silver refining and industrial application, launches its new mandatory export licensing system. This isn't just a new piece of paperwork or a bureaucratic speed bump. It is a strategic decoupling. It is the moment the global silver supply line is officially severed, and the Western technology and solar industries are about to realize that the cheap silver they've relied on for decades has vanished behind a digital iron curtain. To understand why this export ban is the ultimate black swan event, you have to look at the sheer scale of China's dominance. China doesn't just mine silver. They are the world's central nervous system for silver processing. They take the raw door bars from South America and Australia and refine them into the ultra-high purity, a 99.99% silver required for the high-tech revolution. Every solar panel installed in the Mojave Desert, every semiconductor in a Tesla, and every silver zinc battery in the latest AI server arrays depends on a supply chain that begins and ends in Chinese refineries. By implementing an export licensing system, Beijing isn't just counting the silver leaving its borders. They are deciding who gets it, and more importantly, who doesn't. This is silver as a weapon, and the West just walked into the trap with its eyes wide shut. The technical details of this ban are designed for maximum impact with minimum warning. Under the new licensing regime, any company wishing to export silver must prove that the metal is not strategically essential for China's internal industrial growth. Given that China's domestic solar capacity is expanding at an exponential rate, And their Made in China 2025 initiative has evolved into a 2030 goal of total technological self-sufficiency. There is almost no silver that isn't considered strategically essential. This means that on January 1st, the flow of physical silver from east to west doesn't just slow down, it hits a wall. The Western bullion banks, who have historically relied on balancing the books by moving physical metal from eastern vaults to cover their massive short positions in New York, will find themselves staring at a no vacancy sign. The timing of this ban on January 1st is no coincidence. It is a masterstroke of geopolitical timing. By launching the system on New Year's Day, China is ensuring that the full weight of the supply shock hits the Western markets exactly when liquidity is at its lowest and when industrial buyers are resetting their annual budgets. The ghost price, ghost week, flash crash to 75. We are seeing right now is the bank's last desperate attempt to shake the physical metal out of your hands before they lose their ability to import it from the East. They know that once the licensing system goes live, they cannot refill the COMEX vaults with Chinese bars. They are trapped with whatever physical silver is already on Western shores. And as the data shows, those vaults are already at multi-year lows. Consider the impact on the solar snap. The solar industry alone now consumes over 190 million ounces of silver annually, a number that is projected to skyrocket as N-type solar cells, which require significantly more silver than older technology, become the global standard. Most of these cells are manufactured in China using Chinese silver. Up until now, the surplus refined silver was shipped to the West to keep the paper markets liquid and the industrial users satiated. After January 1st, that surplus is legally protected as a national security asset of the People's Republic. If you are a manufacturer in California or Germany and you need silver for your production line, you won't be looking at a $75 ticker in New York. You'll be looking at an empty shipping container. You will be forced to go into the open market and bid whatever price is necessary to pry physical bars away from collectors and investors. This is how a shortage becomes a parabolic spike. This licensing system is the smoking gun because it proves that the 75 price is a complete and utter lie. If there were truly a surplus of silver, if the market were truly crashing due to a lack of demand, why would the world's largest producer feel the need to ban exports? You don't ban the export of something you have too much of. You ban the export of things that are more valuable than the currency when you are being paid for them. China is signaling to the world that they value the physical silver more than they value the US dollars they would receive in exchange. They are choosing hard assets over paper debt. This is the ultimate fundamental divergence. The paper market says silver is a sell at $75, while the world's largest industrial superpower says it SA must hold at any price. The Western tech giants, Apple, Tesla, Samsung, and the AI giants like Nvidia, are about to experience a Sputnik moment. They have built their entire empires on the assumption of just-in-time delivery of raw materials. They assumed that as long as they had the cash, the silver would always be there. But you can't build a computer chip with cash. You can't conduct electricity with a digital ledger entry. You need the atoms. When the January 1st ban severs the supply line, these companies will realize they are in a physical deficit that no amount of money can solve in the short term. The scramble to secure physical silver will be the primary driver of the 2026 market. And the starting gun for that scramble is the January 1st export ban. This brings us back to the $75 flash crash you're seeing today. The institutions are trying to convince you that the smoking gun isn't real. They want you to believe that the Chinese ban is already priced in, or that it won't be as strict as the headlines suggest. But ask yourself, if the banks were confident that the supply was fine, why are they using the low-volume ghost week to aggressively hunt your stop losses? They are doing it because they are terrified. They are front-running the ban. They want to be the ones holding the physical silver when the gates close. They want to buy your silver at $75 today so they can sell it back to the industrial giants at $150 or $200 tomorrow. The January 1st export ban is the structural breaking point of the silver market. It is the moment to the seized paper illusion of the COMEX meets the physical reality of Chinese industrial policy. For the last 20 years, the West has been able to export its inflation and import China's hard assets. That trade is over. The smoking gun has been fired, and the bullet is traveling toward the heart of the Western financial system. You have 72 hours left to decide if you want to be on the side of the people losing their supply or on the side of the people who understand that the real price of silver hasn't even been discovered yet. The $75 dip isn't a reason to sell. It's the last exit before the bridge is lifted forever. When you look at that $75 price on your screen, you're looking at a digital ghost. You are looking at a paper price generated by a financial system that is increasingly disconnected from the physical world. While the algorithms in New York are playing their games, a far more powerful and irreversible force is gathering strength in the real economy. It is what I call the industrial snap. It is the moment when the world's largest tech giants, the Nvidias, the Teslas, and the solar titans, realize that they cannot run their empires on paper contracts. They need the atoms. They need the most electrically conductive metal on the periodic table. And they are about to discover that in a world of infinite digital money, there's a very finite amount of physical silver.